Last one, I promise, folks. Number 6. That's it. We only have 12 slides to go. All right. Not that I couldn't talk us into further than that, but all right, here we go. October 1st, property dividends. We got to do the journal entries for them. The Board of Directors of Kraft Industries declares a property dividend of 2 million shares of Beeman Corporation's preferred stock. Okay, so apparently Kraft has Beeman Corporation's preferred stock, and they're using that as their property distribution. They purchased it in March as an investment, book value of $9 million. The current shares have a value of $10 million, though. Okay, so that's what they're paying out to their shareholders as a distribution. So here's the thing. The first thing we need to do, I'll move myself out of the way. First thing we need to do is we need to bring this thing up to its fair value, because it was worth $9 million to us on our books, but it's really worth $10 million. So the first thing I'm going to do is I'm going to, on the declaration date, is bring it up by the $1 million that we're off. So we're going to debit the investment, bring it up to the proper value, and record the gain on those investments, because we're really distributing something worth $10 million. And then we will debit our retained earnings. Again, this book, I teach in financial accounting that you debit dividends, but it's just one more step in the closing entries. But they debit retained earnings, so we'll let them do that. Debit retained earnings, it's the same treatment, and a credit to property dividends payable. Okay, and here we go. On the date of record, there's no entry, and on the payment date, debit to property dividends payable, and a credit not to cash, because that's not what we're paying out, but a credit to investment in equity securities. That would be that investment. Okay? All right, so here's kind of an overall concept problem. Ellsworth Corp was organized January 1st. The firm was authorized to issue 150,000 shares of $1 par common stock. During 2021, they had the following transactions. They ask you what the total shareholders' equity was at the end of the year. All right, so if we issued 20,000 shares of common stock at $7 per share, that's $140,000. You issued 20,000 shares of stock at $8 per share. There we go. We're just going to do this. That's $160,000. Net income also is going to increase your stockholders' equity. So by $100,000, you're going to pay out dividends of $50,000. That reduces your stockholders' equity. And treasury stock also reduces your stockholders' equity, $3,000 at 10. So the final number would be $320. Stock dividends. Well, why would you pay out stock dividends? Ooh, right? Why wouldn't we just pay out cash dividends? Well, maybe the business doesn't have cash to pay out. So you want to reward your shareholders. You want them to feel like you're paying out something. You may reward them with a share of stock. All right. It doesn't affect your assets, doesn't affect your liabilities, because all you're doing is paying out stock. You're increasing the stock that's out there. Overall, the value that you have in the company doesn't change because, well, I'll get into the numbers in a second. I'll show you that. Kraft declares and distributes a 10% common stock dividend, 10 million shares, when the market value of the $1 par common stock is $12 per share. Okay, so we're going to record the 10 million shares at $12 per share as a debit to retained earnings, which I don't love, but we're going to get into talking about that in a second. We need some kind of debit, right? Credit to, oh, it's not clicking. There we go. $10 a share for the par value piece of it, and the 110 is just a credit to paid in capital excess of par as a remainder. All right. What does the stock market happen? What happens in the stock market when we have stock distributions? Move myself down here. Well, in theory, the market price per share is going to go down because you've now just put a whole bunch more stock out there in the marketplace, meaning that the shares of stock, the market price that it's trading for, should go down. It doesn't change anything as far as ownership, though. All right, what I'm going to do is I'm going to show you, I'm actually going to pause this, and what I'm going to do is I'm going to show you what is going on here. The early rule makers, it's just this odd thing. Really, I mean, the stock market reaction to stock distributions is simply that the market price per share will decline. That's the important takeaway that I have for you here. But since it gives you these 2 to 3 odd kind of bullet points, I want you to be able to pause and read what is written about them. Okay, so I'm going to escape from here. Oh, there we go. Come on. What's written about them, it says, early rule makers felt that there's some sort of justification, something that happened in 1941 that allowed this retained earnings, debiting retained earnings for the stocks. It's an odd situation. It's one that I've never seen, but kind of like par value. It's an antiquated thing. It says this obsolete reasoning is inconsistent with our earlier conclusion. I will let you read through this. The only thing I want you to take away from this is the fact that market price per share should decline. Okay? That's my big piece. But if you wanted to read this, pause it, read it, have at it. we're going to go on from here. Note that we're almost at the end of our slides. Yay! Okay, so we get past this. All right. Like I said, reason for stock dividends, you want to give shareholders the feeling that they're getting a dividend even if you don't have the cash to pay it. And the capitalizing retained earnings, that's part of that second part that I didn't really want to hit on. All right, stock splits. Let's get on to that. Stock splits, again, one of the reasons for stock splits is you want to reduce the market price per share. So if you have a 2-for-1 stock split, it really doesn't do anything as far as the overall value of the stock. Let's say you had a $1 share of stock and now you did a stock split. It's almost like you take a piece of paper and rip it in half and now you have 2 50-cent shares. Okay? The overall value of nothing changes. It's just that you have 2 instead of 1, but the overall value is the same, right? So you had a $1 share of stock, tear it in half, now you've got 2 50-cent shares. It doesn't really do anything. What you're hoping for is that you're going to turn around and sell that share. The price will go back up and you'll have 2 shares of stock to sell eventually. Here's your example. After a company declares a 100% stock dividend on 100 million shares of common stock with a per share market price of 12, now it has 2 million shares with a market value of $6 each. Same thing. The overall value hasn't changed. Okay. Let's see. Move myself out of the way. Keep being in the way here. Now, how do we treat a stock split? Well, you can account for it one of 2 ways, right? We can either with the stock split, we can either do the 2-for-1 thing, right? Like where we're just tearing it in half. But the idea is, can you imagine how intensive that is to have to deal with all of the amount of, all the paperwork involved, everything that ever said that the share of stock was worth $1 is now worth 50 cents. Like it's a lot administratively. So very often stock splits, rather than you accounting for it as a stock split, you would do it as a stock dividend. It's just easier accounting treatment wise. Like I said, there's no actual journal entry for a stock split. It's more that you'd have to change every single piece of paper you have for, instead of $1 stock, now it's a 50-cent stock. So administratively, they very often like to go with a stock. They often like to treat stock splits like stock dividends. Whew, obviously, at the end of my recording here. All right. Kraft declares and distributes a 2-for-1 stock split effect in the form of a 100% stock dividend, when the market value is $12 per share. So we have 2 choices here. We're going to record the common stock that's going out, that extra 100 million shares, right? It's 100% stock dividend, 100 million shares. And we can debit actually paid in capital in excess of par, because that's basically a reduction of a stockholder's equity item. Alternatively, we can debit retained earnings. It's up to the company, whichever they prefer to do it. At the end of the day, it has the same net effect in the sense that it is a reduction, again, of stockholders' equity, whether it's a debit to retained earnings or a debit to paid in capital in excess of par. Debiting the paid out in capital in excess of par, though, kind of keeps it that's in there with the stock, so it's really a stock transaction. When you debit retained earnings, it's not really a stock transaction, so that's a reduction of your retained earnings. So this tends to make more sense. Okay. Very often there'd be disclosure about stock splits. I had no idea in 2015 that there was a 7-for-1 Netflix. Was it 7-for-1? Yeah, 7-for-1 stock split for Netflix. I always think it's funny that people are like, yay, stock split. But it doesn't mean anything. You still have the same value of stock. So anyway, reverse stock split. I guess this happens. I guess we have accounting for it for a reason, and it gives you an example, or at least there's an example in my notes of this happening. I didn't know that was a thing. Reverse stock split, I guess Xerox did it. The idea being it's decreasing the outstanding shares. You would be bringing the market price up on the shares of stock because there are less of them in the marketplace, and it says it's often done by struggling companies, which is probably why it's not very often heard of. My note said it was done in Xerox Corporation in 2017. The idea is if there's a 1-for-4 reverse stock split and there's 100 million shares at $1 per share, your 4 shares of stock would then become, your 4 shares of stock would only become 1 share of stock. So anything you had, if you had 4 shares of stock in your hand, they would now be equivalent to 1. Would become 25 million shares, $4 par. So overall the value stays the same, there's just less of them out there. All right, fractional shares. This happens very often when there is a stock dividend and there's partial shares, and the company doesn't want to give you partial shares because It's a partial share. So if you ever see in your like tax returns or tax return documents, your 1099s or something called cash in lieu, that's where that comes into play. So here's your example just to show you that. If a company declares 25% stock dividend or 5 for 4, I guess that's 5 for 4, yeah. A shareholder owning 15 shares would be entitled to 3 3/4 shares, right? Rather than paying you out 3/4 of a share, they may give you cash for that piece, and that would be considered cash in lieu. So they would give you your 15, they would give you your, no, they'd give you your 12 shares, but they would give you cash for the remainder piece of it. And that's it. We're done. Okay, sorry it's such a long chapter. It is what it is. I hope you enjoy it. I hope you're able to have made your way through this like hours worth of videos. Have a great day, everybody.